Hey, everybody. How are you doing? Welcome to another edition of the video podcast of the Biotech Capital Compass. Thank you for joining us again from wherever you are. I am actually in the great state of North Carolina visiting my mom. I arrived here about 2.5 weeks ago, and then shortly after that, we left for Northern California, where you probably saw a previous video podcast from me at my niece's wedding, which was just fantastic. 5-day event, although we were there for about a week or so. A proper Indian wedding, a great gathering of many families, reconnections, making and making new relationships, renewing old relationships. It was just fantastic. There were a few kerfuffles, as I think they're called, but within the boundaries of what I would constitute a really, really great event. So back here now. Talking about biotech, we published a second part of our series on Vertex. This is the video companion for that. I call this Vertex Biotech and the next test of execution. Now, before we get to Vertex, it's worth sort of setting the broader stage for biotech right now. The tape has clearly improved. The biotech ETF at roughly $170, $176 and change has just hit or approached all-time highs. The XBAT ETF at roughly $138 and change is still well below its early 2021 peak of about 175, but it does look like it's trying to move in that direction. So I say this with about 6 minutes left to the market close here on a Friday in North Carolina. So keeping both my fingers and my toes crossed, we keep this biotech renewal party going, at least in the equity markets. As I said, the equity markets have been working for biotech. Liquidity has improved too, with M&A optimism rising and the IPO window looking more open than it did in 2025. But this still does not look like a full return to the pandemic era strength. Now, again, maybe that's not a fair comparison. I mean, the pandemic era strength was the amount of money that came into biotech got supercharged because we were already on the back end, actually, of an equity funding cycle from about late 2017 to about late 2019. And then the pandemic supercharged that. So, this is natural. I think it'll take us a little bit before getting to those highs and the strength and that liquidity, but it's good to see us sort of, getting back there. As we've been talking for the last year and a half, the trends look good. The milestones look good for biotech recovery. Recent IPOs, have shown better quality and larger deal sizes, yet the number of deals remains well below the highs seen during and just after the pandemic. That's a great standard to aim for. But again, it's not to be doing, it's not shabby that we are where we are at. This is actually pretty good numbers. It's just pandemic was just, so supercharged. So again, this backdrop matters for Vertex because Vertex now sits at an interesting point in the biotech cycle. The part one of our series, which was a video recap, it was free, was about reminding ourselves where Vertex still matters. Part two, which is a very deep dive, over 4,000 words. It's a paid, fundamental newsletter for our readers. It's about the part two is really asking a harder question. What does this company look like now that the sector is rewarding execution again? That is really the heart of the story. For a while, the Vertex debate was straightforward. Cystic fibrosis was such a good business and such a durable one that it could carry a lot of the case by itself, but that is no longer enough. The market has changed. Vertex has changed. The questions have changed. And that is why I introduced what I call the diamond framework. Now, when I was on the sell side at both BTIG and at Oppenheimer and talking to my clients, especially the journalists, I would pitch them the idea of the diamond framework. And I really did it just to simplify biotech for them because biotech can seem very complicated, especially to a person who's just entering it or only has, sort of one toe or 1 foot, in the sector. But the diamond framework tends to just sort of make it easier to understand. And it's really more geared for companies that are profitable. So companies that have revenues and earnings and a pipeline and future competition. So that's basically, the diamond. And let's just get into a little bit more. It's just basically a simple way to think about high quality, profitable biotech companies. At the north end, durable revenue. At the south end, earnings quality and operating leverage. At the west end, pipeline renewal. At the east end, competition and moat durability. And Vertex is a very good company through which through which to apply that framework, because it still scores well on all 4 points, but not as cleanly or as automatically as it once did, which is probably, one of the reasons why the stock has been sort of trading sideways for about, I would say, about a year and a half almost now. But please read the paid newsletter for that. So let's start with the north end, the durable revenues. That is still the easiest part of the Vertex story to believe in. The company has built one of the best revenue engines in biotech through cystic fibrosis, its core franchise. But the real point is not just that the revenues got large; it is how the company got there. This was not one miracle launch followed by complacency. Kalydeco opened the door, Orkambi and Symdeko expanded the treatment population. Trikafta became the major commercial inflection point, and now AlphaTrack, which is the most recently launched combination CF product, looks like the next phase of life cycle management. And again, like I said, you can read our deep dive newsletters, the paid ones, if you want to get more into Vertex understanding the story. Now, this matters for Vertex because it shows the company has not simply harvested a franchise; it has actively built and rebuilt one, cystic fibrosis franchise. And that cash flow engine still appears to matter enormously to the valuation. It gives Vertex room to invest, room to absorb mistakes, and room to push into areas beyond CF without putting the broader business under immediate strain. Now we move to the west end of the diamond, and this is where the story becomes more interesting. Because if CF is the foundation, the next debate is what gets built on top of this. Analyst models make that very clear. Vertex is no longer being viewed purely as a cystic fibrosis company. Casgevy shows up, Journavac shows up, renal shows up. The pipeline is beginning to matter to how the street thinks about the next phase. Here's where I think discipline matters. Not every future revenue line should be taken literally. Some of the more aggressive renal expectations may reflect legacy Alpine thinking carrying over into the acquisition, especially around povetacicept, which is the main asset they bought with Alpine. So what I'm talking about here is in the consensus models in Bloomberg, it's really big numbers for povetacicept, and that's probably because the legacy Alpine models have been brought in by the analysts that cover Vertex, which happens actually pretty regularly, and those just have to be sort of like normalized now. Sometimes for one product companies, smaller companies, some of the further out revenue estimates probably tend to be a little bit optimistic, to put it mildly. Now this happens all the time, as I said, in biotech. A small story gets bought, and some of the old valuation logic comes with it before reality has had time to reshape expectations. So I would not treat these outer year estimates as truth for the renal franchise. In that Bloomberg sort of derived consensus. Again, we show that in our paid newsletter. I would treat that as a signal that analysts increasingly believe Vertex has meaningful shots on goal outside CF, but also a reminder that the company still has to earn that confidence. And that gets us to the south end, earnings quality. Historically, Vertex has looked elite here. The CF business has had beautiful economics, high value products, efficient commercialization, strong margins, clean earnings growth. This is where the picture now gets a little bit more mixed because diversification is not free. Casgevy is operationally complex. Journavac requires broader education and market development. Renal and diabetes may ultimately require more infrastructure too. So even if the core businesses stay very strong, consolidated margins can come under pressure as a company invests through this phase, this diversification phase. And again, if you go to our deep dive full-length newsletter, like I said, 4,000 pages. That's usually an initiation, just to give some people an idea, a small to mid-cap initiation on Wall Street. But I do enjoy writing these. It's a revelation to myself. I always have new ideas come to me while I'm writing those. And those are also actually ideas I've developed over time. So I do enjoy it. And I do hope you also get something meaningful out of these in-depth newsletters that we write. So again, going back to Vertex, I think one reason the stock has become range-bound is that the market is not saying Vertex has lost discipline. It is saying, prove to me that you can diversify without permanently diluting the quality of the model. And that's really where, the one area, in this diamond model, we're seeing Vertex sort of underperforming a little bit, relative to its previous history and its peer group also, it's on margins. Margins are coming down as the company's investing, the CF franchise, where it continues to innovate into diversifying its pipeline, but that worries investors a little bit because, if margins improve, then earnings growth gets better, and that's ultimately what matters to a lot of investors. The earnings logic of Wall Street sometimes can be pitiless, in its simplicity, but it creates a lot of financial discipline. And I, for one, as an analyst, do believe in it. So let's talk about the east end of the diamond. This is the moat. I still think the moat looks real around, the Vertex franchises, most importantly right now, cystic fibrosis franchise. That does not mean competition is absent. Sionna is worth watching. This is a small company that just actually became public and is operating in the cystic fibrosis space. I know some of the folks that work there, that run that company, and really bright, thoughtful individuals. They are, I think, really focused and hope to achieve a lot. Non-modulator approaches in cystic fibrosis are also worth watching, but none of that yet looks close enough in timing or scale to break the near to midterm cash flow story. And how I define near to midterm is near is 1 to 2 years out, midterm is 3 to 5 years out. So again, I think to the end of this decade, the cash flow case for Vertex through cystic fibrosis looks really good, and probably into early 2030s also. And that is why AlphiTrek, the most recently launched cystic fibrosis combination therapy, matters so much. It is not just another product. It's part of the defense. It's how Vertex keeps refreshing the standard of care, before outside pressure becomes more meaningful. That is what good lifecycle management looks like. The moat is not static. It is being maintained. So when you pull all this together, I think the current valuation starts to make sense. Vertex still deserves a premium. The company has quality, it has durability, it has a real moat, it has a pipeline with credible second act potential. That premium is no longer expanding just because the story looks good. And again, we look at that, in the newsletter, our full length newsletter. We're now in an execution market, and Vertex is now in an execution phase. That is probably the most important takeaway from part 2. CF still provides the floor. The moat still protects a great deal of value. The pipeline still offers meaningful upside. And from here, multiple expansion probably depends on cleaner evidence than Casgevy. Journavax and the most important late-stage assets can turn promise into durable commercial reality. That is the shift. Part 1 asks whether Vertex still mattered. Part 2 asks what kind of company it needs to become next. This, our 2-part series. And the answer, at least to me, is that Vertex still looks like one of biotech's high-quality large-cap names. But the next leg of the case is no longer about proving that cystic fibrosis is a great business. It's about proving that what comes after cystic fibrosis can be good enough to matter. So this is really where we are with Vertex right now. We continue to like the name a lot. As we said in the title of part 2, it's still a bellwether. You should follow this story. I think especially for journalists or people still getting more familiar with biotech investing, Vertex is just a great story to cover. And I used to say this when I was on the sell side also in my previous career there, that it's a great way for journalists or people who are not as familiar with biotech investing, kind of familiar with it, to get to know biotech, because Vertex, through its science, its pipeline, but also through commercialization and the future moat, which right now we don't have to worry about, but could over the horizon, in the long term, meaning 5 years or out, it provides a safe space for new investors or people not as comfortable biotech investing to really get to know how biotech works. Again, but I just love the story on a fundamental basis. So anyways, with that, signing off from North Carolina. I hope your weekend goes well, wherever you're at. Sending everyone a lot of good vibes and much love. Take care.